Welcome back. You with us here on the 230 Factor. The market's up 7.5 odd points. There's about a 10-point change on the Sensex as well. This is Wednesday. We got 2 more days, and then next week, of course, is holiday shortened. I mean, a couple of days of holidays next week, and then you have the Infosys numbers coming out on Friday. That is the 15th. So I think 15th is a Friday. Infosys kicks off the earnings season, and we'll see what that looks like. Anil Magdani is with us. He's been running us through his views on the market. Sanjiv Bhasin is with us as well. Sanjiv, good afternoon. Welcome to the show. Just coming to you, Sanjiv. Anil, just a quick point on, what's going on with currencies. The yen, for example, breaking 110, staying around there. Euro. Somebody told me that it seems like the dollar weakness means the US has kind of sacrificed Japan and Europe to prevent and safeguard itself from a steep yuan devaluation. It would seem that way.
On a lighter note first, I think it's pretty much the market is confused and just reacts to the news. So the guy who does the last sort of QE, if you want to put it as QE, gets the massive beating. So first first US came out with QE many years back. The currency got hammered, then Europe followed, then Japan. So as each followed the other, their currency got beaten. Now, the US was the only one sticking its neck out and saying that, we are going to continue with rate hikes, whereas everybody was talking about more QE. The day the US then started talking dovish and started saying no more rate hikes, or from 4 rate hikes to 2 rate hikes to 1 rate hike, or rate hike will not happen till September or maybe even November after the elections, that's when it gets hammered, which just tells me the market is just following the news, and the guy who comes out with the last news gets hammered last. So I think it's a turn of the US dollar. That's on a lighter note. On a more serious note, I think the yen, to be all honestly, it's depreciated all the way from 75 to 125 in 2 years, which eventually led to the stock Japan market also going from 8,000 or 7,000 all the way to 21,000. So it's clearly a play between the currency. A strong currency is bad for the Japanese market and vice versa. Having said that, I think it has broken some crucial levels at 112, 113. The yen should appreciate. Best case scenario 107 if you want to go long the dollar. But in a worst case scenario, I think it could even stretch to 100. But if it went to 100, I think it would be a snap where intra week or intra month it quickly go to 100 and come back to 107. I think 106, 107 is a good support for the dollar. If I again was sticking my neck out, I'd say I'd buy half at $107 yen and buy the balance at 100 with an average of 103 half, keep a stop of 98. My feeling is down the road the yen is going to depreciate to 140, 150 eventually due to all the printing, all the NIRPs, they'll all come into play eventually. But my view is that the stock market, the Nikkei, has to go to 27,000, 28,000. Today it's still at 17,000. It's at 16 now somewhere. So the only way the Japanese market can go to 27 is, I believe, if the yen depreciates. So I'm going to say that you buy at 107, buy at worst case scenario 100, and then you wait for 140, 150 types on the yen over a couple of years, which would also lead to the markets, the Japanese markets doing very well. Coming back to the euro,
which also Anil coincides with Nifty hitting 20,000, right?
Nifty 11,500, not 20. Let's not get carried away. And as far as the euro is concerned, I still think it's a bear market rally for the euro. I think pretty much the trend has been when yields fall, the 10 years, gold tends to rally, equities tends to fall, oil tends to fall, and euro and yen seem to be the risk off currencies. But I don't think there'll be too much upside. If it took out 114, which is a problem area for the euro, I'm looking somewhere close to 117.5, 118. So somewhere around 118 max, but let it take out 114 first.
Okay. So when all this is happening, the dollar is obviously strengthening, right?
It's interesting. I find it quite interesting that when the euro and the Japanese yen rallies, it's risk off, but then that becomes a problem for, I think, commodity based currencies and even emerging market currencies. So I think we are going to get the other way around, where we're going to start to depreciate. So I think the dollar tends to rally against the not so bigger currencies, but it tends to weaken against the euro and the yen when we are in risk off mode, which I think, at least except for the S&P, every other asset class and gold obviously seems to be playing out that way right now.
Yeah, absolutely, absolutely. One has to make the differentiation, which is what is happening right now. I mean, dollar weakening against, or rather steady against these currencies, but strengthening against some of the more weaker currencies, so as to speak. 12 and a half odd points on the Nifty. Sanjiv, why don't you come in? Your thoughts on what's going on, the market, Nifty, how things looking?
Well, we've had an excellent rally. If I recall last time when I was with you, we were below 7,000 and you and most of the panelists were of the view that 6,300 is on the card, and we stuck our neck out and said that this was a brilliant opportunity to buy. The market has played out. I think 68.25 will hold as a low for maybe in the next 2 years. And we think now we are in the fifth wave of correction, which can take us to all the way down to 73, 74. That notwithstanding, we think a time-bound correction between 73, 74 and 8,000 on the top could play out in the next few months. But come August, September, we are confident a new bull market is in the making, which is already played out, Prashant, in the case of soft commodities like tea, sugar, and a lot of the base metals. So we think, a year-end target, if you ask me, 8.5 to 9,000. But year-end 2017, 11,500. So I think extremely bullish on equities with a 2.5-year outlook. And in the near term, in these 4 to 5 months, we think it could be range bound with stock outperformance continuing.
I don't recall, Sanjeev, you said that with an absolutely straight face, like you should, about me calling for 6,300. But I don't recall that at all. But anyway, we won't squabble over that. Let's cut across to Ravi Shankar Prasad, who's speaking right now. Some news points coming in. I think there was a cabinet meeting and he's briefing the press after it. Let's listen in.
अब हम पूरे देश को मारने वाले हैं.
All right, I think some of the announcements which came through were one particular news item. We cut to him late, but he'd already said that oil companies, oil PSUs, will have complete freedom in purchase of oils, crude oil. So that's something that he said. Maybe we should talk to a current or an ex-oil official at one of these companies to understand how it works now and what is the change when the government says that they'll have complete flexibility in terms of purchase of crude oil from world markets. So I think that's the only concrete thing which seems to have come out. I'm looking at wires as well, but if there's more, we'll let you know. There was a lot in your last answer. Digest what? So from here, you're saying what? Market continues to rally, do well?
Yeah,
next 6 months, say.
Yeah, right. So I said till August, September, the volatility globally will be impacting us marginally. But we've definitely made 68.25 would be, I think, a bottom for the next maybe 2 years. And I think, any dip now, the trend of the market from sell the rally has firmly changed into buy the dips. So if you saw bond yields, if you saw FI flows, or you saw the rupee, and if you saw green shoots of macros, they're all pointing out towards a much more pleasant picture than was touted at the beginning of the year. I think the excess volatility also may tend to decline. But like I said, people most of the people on the sideline would wait for results and earnings to start to mature. And that would take some more time. But Prashant, the thing is that the market can keep staying elevated and wait for earnings to catch up, and that is the key point. So will you get these falls which most people are touting? I don't think so. I think 73, 74 also may be one off which can come because of the result season presently, and it will be a healthy correction. But like I said, you have to picture yourself for the next 2 years rather than the next 3 to 6 months. And we think that the broader market and the Nifty outperformance will be a big factor. And as an asset class, I think equities are going to be very, very sweet in the next 2.5 years.
Yeah. I honestly, I admire your confidence, Sanjeev. I just fail to see where it comes from. That even 7,600 is an aberration. Why is it an aberration? What is so great about, in the market, in economy, earnings, anything, which on the back of which you say that even 7,600 is an aberration?
Not
the market fell 2%. You're calling that an aberration?
Not 76. I said 7,300 will be another test of the aberration, but the undertone is definitely firm. So let's not argue on the point. It's that 9,000 may have been a target which we hit well below before time, and we waited. We were ahead of the macros, but we think 75 and below was definitely irrational for the market. And right now also, globally, if we saw, we broke 75 and went all the way to 69, but globally the markets have started to rally much before that. So I think 75 or 72 to 75 is a fair value for the index. We think that is a bottoming out process. And you are what, maybe marginally there or 100 points up because of the extent of the near-term rally. And we think the upside is very way ahead. So we think it will take some more time for the catch-up to take place. The pessimism will give rise to a lot of outperformance, and that may continue in the short term. So like I said, it's going to be all about stocks in the next 4 months. But if you thought macros, bond yields, commodities, everything is playing out in favorably for India. And if 9,000 was misplaced, then even 7,000 definitely was a misplaced high. So we think most of the earnings to catch up and all will take maybe the third half of the last quarter of 2016, but you should start to see at least double-digit growth strongly emerge from a low base, and that is what will trigger the next part of the rally.
Anil, any fundamentals or that you want to talk about? I know technicians calling it not fundamentals but fundamentals. I don't know who that was, but I just remember that.
I'm not a fundamental guy. Just add a very interesting point, maybe not connected to what the other gentleman was talking about, because it's not India specific. I was always taught with all my education to be a capitalist, and I believe I'm a capitalist. So I believe the world has become socialist. I'm pretty disappointed about it. I believe the markets, not in India, but in Europe and US especially, is run by the Fed now. You don't really need brokerage houses to tell you what to do, because every time something is wrong over there, everybody cries about the Fed should increase QE, the government should do this. Government is owning $3.4 trillion worth of bonds and stocks and God knows what out there. So I think the beauty of capitalism is gone. We are now in an economy globally where we just depend on central governments.
Anil, we are in a higher version. We are in a higher version of, it's like, those games, right? We're in a higher version of capitalism. It's a more evolved version of capitalism. I'm saying that tongue in cheek, but
if you get me started, I can get pretty gung-ho aggravated about this conversation, because I'm totally against what's going on. I agree with Mr. Rajan. I think he speaks very well when he says that the world has lost the plot.
What, you think I agree with all? You think I'm in favor of it? But
no,
all the regular, over the last Anil, all the 6-7 years, all the 6-7 years when QE has happened, I'll tell you, this is something which has happened. I know this for a fact. All the capitalists, right? When you said you're a capitalist, and I'm assuming that most people who work on the sell side, fund managers, they're capitalists as well. I don't recall anyone. When it stopped working over the last 1 year or so, at least the marginal utility started falling. Till that point, everybody was extremely happy that they did it. Even still, they'd say, well, this was the need of the hour. So I don't know. It's maybe that's why I said maybe it's I'm missing something. Yeah.
The hour is over. I think as soon as the S&P falls 5% or any stock markets falls 5 to 10%, all central bank governors start jumping on their seats. Their job is not to watch the stock market. Their job is to watch the economy. But they seem to gauge that the stock market is a clear indicator of the economy. So if the stocks fall, immediately you have to announce. You announce QE, you announce NIRP, you announce whatever you have. But get the stock markets up. We cannot have a weak stock market. You give credit to Donald Trump, for imagine a guy who's standing for elections to be a president of the biggest country in the world, sticks out and says the stock market is way overvalued and all what we're saying is all humbug. For a potential presidential candidate to say that is quite impressive. I'm not a Trump or hater or fan, but I think that's a very bold move. But even coming back to Mr. Rajan, because I have a lot of respect for him, I think for many years he's been against this whole QE, against what, even though he knew Ben Bernanke on a very personal level, he's always been forthright and upfront saying that this is not the right way forward. But unfortunately, what we said initially that it should not be done, now we've got so used to it that anytime something bad happens, we look to the central banks and say, now it's your turn, bail us out.
Yeah. No, absolutely. By the way, S&P 2000 plus shows, I mean, if that is the real indicator, then the US economy is doing just fine. You would agree with me, right? $120 earnings, S&P 500, trading at 17 times, just fine. So this is what Rajan said, Raghuram Rajan today said in an interview that I was referring to earlier. He said QE infinity may keep asset prices high for a long time versus fundamentals. It's not new. It's nothing new. He said it before. So for lay viewers, I mean, who don't want to get into the intricacies of what is right, what is wrong, what to make money, they have to entertain that possibility as well, right? That, as they say, you can't fight the Fed or central banks or whatever. So you got to appreciate that finer point, appreciate that nuance, right? So you got to be on the right side. Yeah, go on.
Another small story. I remember just a couple of months back or a month back, Janet Yellen was sitting in one of these committee meetings where she has to justify what she's done. And she says that, the guy asked her that you've increased the rate from 0.05 to 0.3. So if the interest rate is 0.3, why are you paying the banks 0.5 when you're keeping their funds with you? So that Janet Yellen, goes ahead and says, well, we have to support the banks. The banks are not that well off, so we have to give them higher rates of interest than what we are collecting. The guy said it very nicely. He said, so you are telling me after $3.4 trillion of printing and buying all those junk assets of the bank, you still have to support the bank after 5 years. Then when are they ever going to function on their own?
Yeah, no, absolutely. I've enjoyed some of these interactions. I mean, that's the beauty, right? It all happens on camera, so you can watch it.
I'll just come back to one more point, which is more pertinent to our markets. And with all due respect to Mr. Bhasin, I didn't get his name. Interestingly, as a technical analyst, what I have followed over the last few years, with the exception of post-QE, and this applied to all markets and it still applies to India. Interestingly, stock markets do extremely well when actually interest rates are going up, not when they're going down. It's a myth that interest rate cuts, yes, they are good for the economy. Again, I'm not a fundamental guy, so I'm not going to comment on how the interest rate cuts affect the economy. I'm sure they do well to kickstart demand and whatever. But historically, if you study, even when the 2013 August bottom was made, when Chidambaran was still the finance minister and he was cutting rates, after that, they started increasing rates again because of the inflation factor towards the end of 2013. And that's when we had again another big stock market rally from 5,900 to 9,000. Even the stock market rally of 4,000 Sensex to 21,000 Sensex was 3 years of continuous rate hikes. Even the 2000 top, I checked the US markets also. The interest rate topped out in 2000, the interest rate topped out in 2007. As soon as the interest rate started falling in 2001, as soon as the interest rates start falling in 2008 March, the stock markets crashed. So it's great for the economy to cut rates, but I'm a firm believer. And the classic example is India today. From November of 2014 till date, don't see what happens immediately after the rate cut. See 2 or 3 months later, after 6 rate cuts, why did we fall from 9,100 to 68.25? You answer the question. The answer is the stock markets do not do well in a rate cutting environment. It only does well when the rates are good. Very clear, I've studied the history. It's a proven fact, except for the post-QE period in the US. But in India, it still follows the same path. Lower rates, the market goes down, come what may. I don't know why every time we have an RBI policy, everybody wants a rate cut. It doesn't do any good for the stock market.
Maybe they're looking at that day or the day after or whatever. I mean,
I'm not a longer guy, so I'm a stock market guy. I will look for my market to go up. So That's me, I guess.
Absolutely, 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 absolutely. Sanjiv, don't look so worried. Any closing comments? Sanjiv is
why should
just
I
wrapping
worry?
up.
Why should I worry? You know, we say that all these are lessons in hindsight. So whether we are correct or right, you know, I'll come back to John Keynes, the famous economist, what he said. The markets can be irrational longer than you can be solvent. So, you know, if you are bearish, you better watch out, because 7,000, and, you know, it took 11 months to fall from 9,000 to 7,000. And in almost 1 month, you did 800 points. That's telling you the extent of overshooting on the downside. And that's also a warning lesson to most bears, that watch out for further movement.
Fair enough. You're saying this. I think you're saying the same thing as what Anil was saying, that maybe 6,800 was overdone, 9,000 was overdone as well. That's what you're saying, right?
Exactly.
So,
but look at the extent of the pullback, Prashant, and the speed. It tells you that inherently the underperformance of India got overdone, and now you are looking for outperformance. Sure. Now is truly the time when any decline should be actually used to buy. And like we said, you know, fundamentals, macros, everything will play out more favorably. And you're starting on a lower base. You're not closer to 9,000, you're closer to 7,000. So all the more room for comfort and all the more room for earnings to catch up. And, you know, like we said, if there is one asset class which has underperformed and which should outperform, it is going to be equity in the next 2.5 years.
Sanjiv, one stock which you are very bullish on, absolute, forget about relative performance, one stock, just one stock which you think would make a lot of money.
Godrej Properties.
Godrej Properties.
Simply, I'll take 1 more minute. It's a premium play, and it's a pedigree management, and you know, it's not doing back-end processing. So if they have a 10,000 crore order book for the next 1.5 to 2 years, their land bank is zero. That is telling you that on lease rental, they are selling first and then acquiring, and then doing the whole process of construction via play. And if you recall, the same play was done by a stock which I, on your channel, picked up at 225, that was NBCC. A stream construction quasi play on tier 1, tier 2 and metros. And that stock is of course 950, but I'm looking for way beyond 2,500 in the next 2 years. So that's the same status we are giving to Godrej Property, pedigree management in the worst sector, which is now looking for recourse. And we think the order book and the implementation will be very, you know, the progress will be very, very fast. So we think this and NBCC continue to be our two outperformers for the next 2 years.
Gentlemen, thank you very much. Appreciate both of you staying on. Sanjiv and Anil, appreciate your time here, as always. Thanks very much, and see you back soon, hopefully. Take a quick break here. I have to do that. And there's about, 17 minutes to go, 18 minutes to go for the market closing, 3:30. So we are back in 2, and we'll do the closing with more guests on the other side. Stay with us.